You might think keeping your money in the bank is safe. After all, the savings account has always been where you keep your nest egg, right? But after 60, that safe habit could be the very reason you're quietly losing wealth month after month. It seems harmless enough. You worked hard for decades, you saved what you could, and now you're relying on that cushion to carry you through retirement. The bank tells you it's secure. You check your balance and it looks the same every time. No losses. No risk. But the truth is, every year that passes, your money is shrinking in value. That's the hidden danger of inflation. Think of it this way. In 2000, a cup of coffee might have cost you 75 cents. Today, the same cup is easily $2 or even $3. The money in your account didn't shrink, but what it can buy did. That's inflation at work. And if you're over 60, the impact is far more dangerous than when you were 30 or 40.
Why?
Because time isn't on your side anymore. You don't have decades left in the workforce to earn back what inflation quietly steals from you. And worse, as interest rates go up and down, the bank never keeps up. In fact, most savings accounts are paying less than 1% interest, while inflation is quietly eating away at 5, 6, even 8% of your purchasing power each year. It's like filling a bucket with water while there's a hole in the bottom. You keep saving, but the leak is faster than the faucet. And here's the hardest truth. That safety you feel seeing the same number in your account is an illusion. Because in reality, your money is worth less and less with each passing year. But here's the good news. You don't need to gamble in risky stocks. You don't need to chase complicated investments you don't understand. You just need to switch to a smarter kind of protection. In this video, I'll show you 4 proven ways seniors can shield their money from inflation. They're safer than stocks, simpler than real estate, and specifically designed to preserve your purchasing power as you age. And the number one option at the end of this video doesn't just protect your money, it can also give you steady income month after month, so you never feel like you're draining your savings just to get by. So stay with me until the end. Because the difference between slowly losing money every year and protecting it so you can enjoy life without worry could begin tonight. You see, it's not enough to simply hold on to your savings. After 60, you have to make your money work in a way that protects it from shrinking. Traditional savings accounts, CDs, or even bonds often can't keep pace with inflation. And if you're relying on them, you're silently slipping backward, even if you don't see it happening. The problem isn't your discipline. It isn't that you didn't save enough. It's simply that the financial world has changed. Prices rise faster than banks reward savers. Medical costs, groceries, gas, housing, all of them climb higher every year. Meanwhile, your money sits still. That's why you need investments built for stability and protection. Investments that carry intrinsic value, adjust with inflation, or deliver predictable income that grows alongside the cost of living. And the best part? You don't need millions to get started. Even small amounts, shifted wisely, can make a noticeable difference in how much you can afford each month. Each option I'm about to share has one thing in common. They're not about getting rich quick. They're about protecting what you've already earned. They carry specific qualities that help your money resist inflation, maintain purchasing power, and, in some cases, even grow at a rate that beats rising costs. Some are tied to physical assets that rise in value as prices rise. Some are backed by the government to ensure stability. Others are structured to give you reliable cash flow, so inflation doesn't leave you strapped for everyday expenses. And most importantly, they don't expose you to the kind of roller coaster risk that makes retirees lose sleep at night. So, here is the list of 4 investments that can replace plain savings accounts in your retirement years. They won't just help you protect your money. They may also help you sleep better at night, knowing inflation can't quietly drain your wealth. We'll go from the most familiar option to the most powerful one. And the number one investment at the end of this video is something many seniors overlook, but it can provide both safety and steady income year after year. Number 4. Number 4. Treasury Inflation-Protected Securities, also known as TIPS. At first glance, these may sound intimidating. Government bonds? Inflation protection? It feels like something you'd need a financial advisor to understand. But the truth is, TIPS are one of the simplest tools seniors can use to fight inflation without taking on big risks. And they've been around for decades, quietly protecting investors who know how to use them. Here's how they work. Normal bonds pay you interest, but the value of the bond itself never changes. If inflation rises, your bond stays the same. That means, in real terms, you lose purchasing power. But with TIPS, the U.S. Treasury ties the value of the bond directly to the Consumer Price Index, the government's measure of inflation. So when prices go up, the value of your TIPS investment adjusts up with them. When inflation rises, your payouts increase. When inflation is steady, they hold value. And because they're issued by the U.S. government, they carry the full faith and credit of the Treasury, which means the risk of default is practically zero. Think about that for a moment. Imagine if your Social Security check automatically increased not just with a cost of living adjustment once a year, but in real time with every tick upward in prices. That's the principle behind TIPS. They aren't about making you rich. They're about ensuring what you have now won't be eaten alive by tomorrow's prices. For seniors, this is critical. You're living on a fixed income. You can't control inflation. But with TIPS, you can at least insulate your savings from its worst effects. Let's look at an example. If you buy a $10,000 TIPS bond and inflation rises 5% over the year, your bond doesn't stay at $10,000. It increases to $10,500 automatically. That means the interest you earn also rises, because it's calculated on the adjusted amount. Year after year, it moves with inflation. Compare that to a standard bank CD or savings account where the interest rate doesn't budge. You can see why TIPS are so valuable, especially now. Studies from the Federal Reserve have shown that retirees who include even a small allocation of TIPS in their portfolios maintain stronger purchasing power over 10, 15, and 20 years than those who rely solely on traditional bonds or savings. And here's the best part: you don't need to be wealthy to access them. You can buy TIPS directly from treasurydirect.gov in increments as low as $100. There's another advantage seniors often overlook. TIPS not only adjust for inflation, but they can also provide a sense of peace. Because instead of worrying every time you see the news talk about higher grocery bills or gas prices climbing, you know at least part of your nest egg is climbing too. That mental relief is worth more than dollars. It gives you confidence that you can keep up, no matter what's happening outside. Of course, no investment is perfect. TIPS have one drawback. In rare periods of deflation, when prices fall, the principal adjusts downward. But historically, those periods have been brief and mild compared to long stretches of inflation. And once prices rise again, the adjustment resumes upward. For most seniors, especially over the long term, the protection far outweighs the occasional dip. So how should you use TIPS? The key is moderation and timing. You don't need to put your entire nest egg into them. Instead, think of them as a shield. If you hold a portion of your retirement savings in TIPS, you've built a safety net against inflation. The rest of your money can stay in other safe assets or even in cash for emergencies. Experts recommend buying TIPS in laddered maturities, some that mature in 5 years, some in 10, some in 20. This way, you're always adjusting to the current environment, and you never have to cash out all at once. And unlike complicated investments, you don't need a broker to get started. Treasury Direct makes it straightforward, and many retirement accounts already allow you to add TIPS-focused mutual funds or ETFs if you prefer not to buy them individually. And here's one more important point. If you're concerned about taxes, know that the inflation adjustment on TIPS is taxable each year, even if you don't cash them out. That's why many seniors hold TIPS inside tax-advantaged accounts like IRAs, where the growth compounds without yearly tax bills. If your money is sitting in an IRA already, this could be one of the easiest switches you'll ever make. Imagine this: you've got $50,000 in savings. If you leave it in a standard account earning less than 1% interest while inflation runs at 6%, in 10 years that money will only buy about $27,000 worth of goods in today's dollars. That's a devastating loss of purchasing power. But with TIPS, even if returns are modest, the inflation adjustment helps preserve that value. You're not going backward. You're holding steady. That's the key. Protection, not speculation. As a senior, you don't need to take wild risks to stay ahead. You just need to put part of your money into vehicles that move when prices move. And TIPS are one of the most straightforward ways to do that. If you've never heard of them before, or if you've always thought bonds were boring, now is the time to look again. Because boring might be exactly what you need: boring, stable, and safe, with built-in inflation defense. Try starting small. Even a $1,000 purchase can give you a taste of how they work. Track how the value adjusts every 6 months, and notice the comfort of knowing you're not standing still while prices rise around you. If you find it reassuring, expand from there. And if you've already used tips, share your experience in the comments so others can learn. Your story might be the encouragement another senior needs to finally protect their savings. Tips are a wonderful choice if you want a government-backed, inflation-proof option. But if you're worried about rising costs in everyday life, especially healthcare, food, and energy, the next investment might be even more important. It's tied directly to real-world resources, and it carries a built-in hedge against rising prices in areas that matter most. It doesn't just preserve your money on paper. It ensures your wealth keeps its strength where you actually spend it. Number 3. Number 3. Commodities with a focus on precious metals. For many seniors, the word commodities sounds like Wall Street jargon. You might picture traders shouting in a pit about oil, wheat, or copper. But when we simplify it, commodities are just real-world resources, the things people need and use every day. And when prices rise, these resources rise with them. That's why commodities have always been a natural hedge against inflation. Among them, gold and silver stand out. They're not new. They've been used as stores of value for thousands of years. When paper money loses purchasing power, gold and silver don't vanish. They hold steady, and in many cases, they rise. That's why, throughout history, people have turned to precious metals during times of uncertainty and inflation. Think about it this way. If you held a $20 bill in 1970 and you held a 1-ounce gold coin, which one would have preserved your wealth today? The $20 bill still buys a couple of lunches. That same gold coin, which cost $35 back then, is worth over $1,800 today. The paper lost most of its strength. The gold multiplied. For seniors, this matters because you're no longer playing the long game of decades. You need protection right now, in the span of 5, 10, maybe 20 years. Gold and silver can give you that protection without relying on a bank or a government promise. They're assets in themselves, not just numbers on a statement. But it's not just about history. Modern studies confirm the role of precious metals as an inflation shield. A 2021 report from the World Gold Council found that in periods of high inflation, gold prices rose an average of 15% per year, while stocks often struggled. That's the kind of offset that can keep your portfolio balanced when everything else feels shaky. And unlike speculative investments, gold and silver don't depend on a company's earnings or a CEO's decisions. They don't go bankrupt. They simply exist as real assets that people everywhere value. That makes them uniquely suited for retirees who want stability. So how can you actually own them? You have a few options, and each one carries its own benefits. The first is physical gold or silver, coins or bars you can hold in your hand. For many seniors, this feels reassuring. It's tangible. It can't be hacked or erased. You know it's there. But you need to store it safely, whether in a home safe or a bank's safety deposit box. The second is exchange-traded funds, ETFs, that track gold or silver. These are simpler if you don't want the hassle of storage. You buy them through a brokerage account, just like a stock. They move with the price of gold or silver, giving you exposure without physical handling. The third option is mining stocks or funds that invest in mining companies. These can sometimes amplify gains when metal prices rise, but they also come with more risk. For seniors who want safety, sticking to physical metals or ETFs is usually wiser. And here's the key, you don't need to go all in. A small allocation, even 5 to 10% of your savings, can make a big difference. That's because when inflation spikes, metals tend to move in the opposite direction of paper money. They rise as the dollar weakens, helping to balance your overall wealth. Imagine this. You have $100,000 in retirement savings. Inflation runs high, stocks dip, and your purchasing power falls. But the $10,000 you put into gold has now risen to $12,000 or even $13,000. That gain helps offset losses elsewhere. You haven't stopped inflation, but you've shielded yourself. This isn't about becoming a gold bug or betting your life on shiny coins. It's about balance. It's about making sure at least part of your savings is anchored in something that moves when prices move. That way, you don't watch helplessly as your nest egg shrinks in real terms. And here's something many seniors don't realize. Precious metals can also provide peace of mind in emergencies. If the financial system hits turbulence, a banking crisis, a market crash, metals remain valuable. They give you optionality. That sense of security can reduce stress, which matters just as much for your health as for your wallet. Of course, there are cautions. Precious metals don't pay interest or dividends. They simply hold value. So you shouldn't rely on them for income. And their prices can fluctuate in the short term. If you expect them to rise steadily every month, you'll be disappointed. But over the long arc of inflationary periods, they shine. So how should you begin? Start small. Buy a single gold coin or a handful of silver coins. Hold them. Notice how it feels to have a piece of enduring value in your hand. Then, if you're comfortable, add a little more. Or use an ETF to make it effortless. And if you've ever owned precious metals before, you already know the quiet comfort they bring. That sense that no matter what happens, you've stored a portion of your wealth in something timeless. If that resonates with you, share your story in the comments. Other seniors might take encouragement from your experience. Commodities like gold and silver are excellent for protection. But what if you're looking not just to preserve value, but also to generate steady income that can grow with inflation? That's where the next option comes in. Because while metals defend your purchasing power, the next investment actively pays you to hold it, month after month, year after year. It's one of the most overlooked tools for seniors, but it can transform the way you experience retirement. Number 2. Dividend-paying stocks in essential sectors. Now before you panic at the word stocks, hear me out. I'm not talking about gambling in the market, chasing hot tech names, or trying to time the ups and downs. That kind of speculation is stressful and unnecessary, especially in retirement. What I'm talking about is far more stable. Companies that have been paying steady, reliable dividends for decades, and raising them year after year, even through recessions and inflation. Think of names you already know. Companies that make food, provide utilities, supply healthcare, or manufacture everyday goods. These aren't flashy. They're not the companies making headlines for explosive growth. But they are the ones that keep paying their shareholders, rain or shine. For seniors, that's the kind of reliability you need. Here's why dividend stocks matter in inflationary times. First, they pay you income on top of your investment. If you hold a stock that pays 4% in dividends, that's money deposited into your account every quarter, whether the stock price rises or not. Compare that to a savings account paying less than 1%. The difference is immediate. Second, many of these companies increase their dividends regularly. That means your income grows over time, helping you keep up with rising prices. A classic example is the group known as the Dividend Aristocrats, companies that have raised their dividends every year for at least 25 years. Some have raised them for over 50 years straight, through wars, recessions, and inflation spikes. That's the kind of track record you can count on. Let's make this concrete. Suppose you invest $20,000 into a basket of dividend-paying stocks that average a 4% yield. That's $800 a year in cash payments. But unlike a fixed bond, many of these dividends grow. If the companies raise payouts by 5% annually, in 5 years your income isn't $800 anymore, it's over $1,000. In 10 years, it's closer to $1,300. That growing stream of income is what helps you battle inflation without touching your principal. And remember, these aren't obscure investments. These are the companies behind the food in your fridge, the medicine in your cabinet, the electricity running your home. People need them no matter what happens in the economy. That stability is why they can keep rewarding shareholders while other sectors struggle. A study from Hartford Funds in 2020 looked at returns going back nearly a century. It found that dividends accounted for about 40% of the stock market's total return over time. More importantly, dividend-growing companies outperformed non-dividend payers in nearly every inflationary period. That's powerful evidence that dividends don't just pad your income, they provide real resilience. Now, you might be thinking, stocks are risky. And yes, they can fluctuate in price. That's why the key is to focus on quality and income, not short-term gains. If you choose companies with long histories of paying and raising dividends, The temporary ups and downs matter far less. Because while the price on the screen may wiggle, the cash flowing into your account keeps arriving, quarter after quarter. And here's another option if picking individual stocks feels overwhelming: dividend-focused exchange-traded funds, ETFs. These are baskets of dividend-paying companies bundled together. They give you instant diversification, so you're not relying on a single stock. Many of them are built specifically to track dividend aristocrats or high-yield sectors. For seniors, this can simplify everything. So how do you get started? You don't need to invest huge amounts right away. Even a small allocation, say $5,000 to $10,000, can begin generating extra income. Watch how the dividends show up in your account. Notice how they grow over time. The feeling of money arriving without selling anything is empowering, especially in retirement. Of course, there are cautions. Don't chase the highest yields. If you see a stock promising 10% or more, it's often a red flag. Sustainable dividends are usually in the 3 to 6% range. Stick with companies that have proven track records. And don't put all your savings here. Dividend stocks are a complement to safer options like tips or precious metals, not a replacement. But when balanced correctly, they can give you something no savings account can: income that rises with inflation. That's the missing piece for many seniors. Instead of watching your nest egg shrink year after year, you're watching a steady stream of cash flow grow. That's not just financial security, that's peace of mind. Now, if dividend-paying stocks help you keep up with inflation while generating income, the number one investment brings it all together. It doesn't just protect your purchasing power. It also provides direct, tangible support for your lifestyle in retirement. It's been quietly available for decades, but many seniors overlook it because it feels too unfamiliar. Yet for those who use it, the difference can be life-changing. This final investment not only shields your savings from inflation but also turns part of your money into a reliable paycheck, one that keeps coming for as long as you live. It blends safety, growth, and income in a way few other options can. And if you've ever worried about outliving your savings, this could be the solution you've been waiting for. Number 1. Lifetime income annuities with inflation protection. Now, I know what you might be thinking. The word annuity makes a lot of people cringe. Maybe you've heard horror stories about high fees, confusing contracts, or pushy salespeople. And yes, some annuities are complicated. But not all of them. When chosen carefully, certain annuities can be one of the most powerful tools seniors have to protect their money from inflation while guaranteeing income for life. Here's why. Unlike a savings account that just sits there, or a stock that might go up or down, an income annuity is designed to pay you a steady stream of money every month for as long as you live. It's like creating your own personal pension. And some versions, called inflation-adjusted annuities, actually increase those payments over time to keep pace with rising costs. Think about what that means. Instead of worrying if your savings will run out, or if groceries will cost more next year, you've locked in a paycheck that arrives no matter what. It doesn't matter if the stock market crashes, or if interest rates change, or if inflation spikes. The payments keep coming, backed by the insurance company that issued the contract. For seniors, especially after 60, this addresses two of the biggest fears: outliving your money and losing to inflation. Annuities solve both. They turn a portion of your savings into a guaranteed paycheck you cannot outlive. And with the right rider or inflation adjustment, those paychecks grow to match the rising cost of living. Let's put this in perspective. Suppose you take $100,000 of your savings and use it to buy an inflation-protected annuity at age 65. You might start with payments of $450 a month. Each year, those payments adjust upward by the rate of inflation. In 10 years, when groceries and healthcare are more expensive, your monthly payout might be closer to $600. In 20 years, maybe $800. All without you managing investments, worrying about interest rates, or checking the market. A study published by the Journal of Financial Planning found that retirees with even a modest portion of their portfolio in lifetime income annuities reported significantly lower stress and higher satisfaction in retirement. Why? Because they weren't watching their accounts drain down year after year. They had the peace of mind of a steady, predictable paycheck. Of course, not every annuity is right for everyone. Some have high fees or unnecessary extras. That's why it's important to focus on simple, transparent annuities designed for income, not complexity. Look for ones that specifically mention inflation adjustment or cost of living increase. And always compare options from multiple providers before choosing. So how much should you put into an annuity? Experts often recommend using enough to cover your basic monthly needs: housing, food, healthcare, utilities. That way, even if inflation rises or the market falls, your essential expenses are always covered. The rest of your savings can stay in other investments for flexibility and growth. And here's another important tip. Don't wait until your savings are already stretched thin. The earlier you consider an annuity, the more options you have and the better your payout rates may be. Even setting aside a portion of your nest egg can transform the way you experience retirement. Some people worry about giving up access to their money. And yes, with annuities, you're trading a lump sum for guaranteed income. But think about it this way. Would you rather hold a pile of cash that shrinks every year because of inflation, or would you rather turn part of it into a lifelong paycheck that grows as costs rise? For many seniors, that trade-off is worth it. If you've ever laid awake at night worrying if your money will last, or if inflation will eat away at your comfort, this may be the solution you've been looking for. It's not about chasing returns. It's about creating security. It's about giving yourself the freedom to enjoy retirement without constantly checking prices or bank balances. So, which of the 4 options we covered will you explore first? Will you try the safety of tips, the timeless value of gold and silver, the steady payouts of dividend stocks, or the guaranteed lifetime paycheck of an annuity? Each one plays a role. And together, they can shield your retirement from the silent thief of inflation. If you've already tried one of these strategies, share your experience in the comments. Your small story might be exactly what another senior needs to finally protect their savings. And if you want to keep learning practical ways to preserve your wealth and live with peace of mind after 60, tap the subscribe button and turn on notifications. I'll be here every week, walking alongside you step by step, helping you defend your money, grow your confidence, and enjoy the retirement you've worked so hard for. Because you deserve not just to save, but to live securely, today, tomorrow, and for the rest of your life.